Hi friends, good evening. Welcome everyone for today's session on tax and TDS implications for non-resident e-commerce operators. So we thought again this is again a specific sector which requires due consideration, and there was some ambiguities as to what falls within the ambit of tax or TDS when it comes to e-commerce operators. So thought let's have a session on that to clear some of the ambiguities. Before starting, would like to acknowledge the efforts of CA Farha for preparing this PPT. The legends used pretty similar to what we have seen earlier. EL stands for Equalization Levy, and SCP stands for Significant Economic Presence. The schema for the evening, the background, or rather, I would say the introduction, non-resident taxation in India, significant economic presence, equalization levy, TDS provisions, and OECD's measures in taxing the e-commerce space or e-commerce operators. Uh, there have been some issues in taxing e-commerce operators worldwide, but India has been a forerunner in adopting all the suggested propels by OECD. In 2015, there was introduction of BEPS Action Plan 1 following the OECD's 1998 Ottawa report on e-commerce. In 2016, introduction of Equalization Levy through Finance Act 2016 to tax online advertisement income. Yeah, as of today, the scope has been expanded to e-commerce operators via the Finance Act 2020. 2018, OECD's inclusive framework delivered the interim report on tax challenges in digital economy. Introduced SAP, so even SAP was introduced at a significant economic presence in 2018, which was applicable from financial year 18-19, again by virtue of Finance Act 2020. As there are still few ambiguities to clear, the applicability of SAP has been deferred till financial year 21-22. Issue of policy note by inclusive framework, which grouped the tax consideration into two pillars, which happened in 2019. That is again the two rules, that is the nexus rule, taxing rights with physical presence, three proposals on allocation, and second is the minimum level of tax to be imposed. It was a public consultation document and was agreed to reach at a consensus by end of 2020. We have already done a webinar on this, friends, if you want to see what exactly this document said about. 2020 expansion of scope of equalization levy to non-resident e-commerce operators, as I have already said. Again, introduction of TDS on payments made by e-commerce operators to e-commerce participants, differing SEP to financial year 21-22. So these have been the or I would say evolution of tax and TDS on e-commerce operators in India. This is specifically for India as a jurisdiction. Non-resident taxation, as you know, as per Section 5, subsection 2, provides for any income received, deemed to be received, accrues or deemed to be accruing in India, that would be subject to tax in India. So accrued or deemed to accrue, received or deemed to be received, that would be subject to tax in India. Deemed to accrue or as in India, again it is mentioned in Section 9, and there is a concept of business connection, which is again giving birth to a concept of significant economic presence. In the context of digital economy, particularly for e-commerce operators, where rendering of service cannot be mapped to a particular location and the beneficiaries are spread across, the concept of business connection, or P, which is again an equivalent of business connection in DTAA, as defined in the case of a brick and mortar operation, did not seem to work. So again, friends, when it comes to e-commerce operators, specifically concept of business connection may not work because business connection or permanent establishment talks about a kind of a physical presence, either in the form of an establishment or in the form of a person. But here again, when it comes to e-commerce, in reality there may not be any presence, but still income would get generated from operations in India. So that's where the concept of significant economic presence emerged. Initially, it was effective from financial year 18-19, but again by virtue of Finance Act 2020, it has been deferred to financial year 21-22. So what exactly is significant economic presence? The introduction of SEP provides India with the right as a source country to tax revenue generated from Indian market. This is again taxing our the e-commerce giants like Facebook, Google, and other players, wherein they earn their income, or I would say a major chunk of income from India, but still there is no taxability per se when it comes to India as a jurisdiction. So that's why the concept of a SEP has been introduced so that India gets its fair revenue share. SEP may be triggered in India for nothing in the following circumstances: transactions in goods, transaction of goods in India, transaction in services in India, that is again royalty and FTS. Again, there's an issue or ambiguity here. Transaction in property, including provision of download of data or software, and systematic and continuous soliciting of business activities or engaging in transaction with such number of users in India through digital means. Again, the prescribed transaction and the prescribed number of users or data that has not been available as of now. Yes, we can expect a CBDT circular ASAP when it comes to applicability of SEP for 21-22. The above circumstances would result in SEP in India on exceeding a certain threshold amount, which is or user limit, which is again not yet prescribed. SEP would be triggered in India irrespective of the following: the agreement for such activity or transaction is entered in India, non-resident has a place of residence or business in India, the services are rendered in India. So, friends, if you see the main section, it talks about transaction in services in India, and when it comes to again a proviso which states that SAP would be triggered in India irrespective of services are rendered in India. So these two are contradictory points. Again, we require a CBDT clarification on this as to what would prevail, whether services are required to be rendered in India for SAP to trigger or not. Once a SAP is triggered, a PE is established for the North in India, and so much of income as is attributable to the activities carried out in India shall be taxable as income of the PE. However, no specific method as for the attribution of income has been prescribed. But yes, as we have seen in our earlier webinar as well, when we took for business connection versus permanent establishment, CBDT has come with, or I would say, there is no a rule or a regulation, but the formula approach, wherein the weights are being given to various units, be it sales, number of employees, assets, etc. In there has been a reference of SAP as well when it comes to significant economic presence, also how to tax in terms of number of users or number of transactions. In case of tax treaty countries, non-resident can choose to apply the treaty provisions. Yes, because it is said either the domestic tax law or treaty provisions, whichever is beneficial. The section was introduced by Finance Act 2018 with effect from financial year 2018-19, but currently deferred to financial year 21-22. OECD guidelines on SEP as to what are the factors which would create significant economic presence: the existence of a user base and the associated data input, a volume of digital content derived from the jurisdiction, maintenance of a website in local language, billing and collection with a local currency, responsibility of final delivery to customers, provision of other support services, sustain marketing and sales promotion activities either online or otherwise. So these are the factors which may be relevant. Again, it's a guideline of OECD, so CBDT has to come up with its guideline as well as to what are the factors which will contribute to significant economic presence in India. Again, there are some open issues. Offshore supply of goods till date are out of tax ambit. So offshore supply meaning there is there is no involvement of India in any sense when it comes to supply of goods. Those are outside the ambit. So India does not have a jurisdiction to tax. However, the introduction of SAP would unsettle the settled position as it is not restricted to goods purchased digitally. So there is a CBDT press notice basis which there would be even applicability of SEP and in turn the taxability of income in India. SAP also applies to services which includes royalty and FTS. But again, there are specific provisions relating to taxing royalty and FTS. If you see section 916 and 917, and also there are specific articles in DTAA which deals with royalty and FTS. So in this scenario, whether royalty and FTS would get triggered under significant economic presence, and whether we need to see PE for that, or it will get under a specific inclusions of these items under specific provisions of 916, 917, or Article 12 or 11, as the case may be. Obviously, specific provisions would prevail over the general provisions. Downloading of data, term data, is of very wide import and would include any facts or pieces of information. Data can get downloaded on opening a web page or accessing a video and would lead to unintended consequences. Suitable clarification or amendment to the language may be required. Again, there has to be a need to define data, what exactly would mean data when it comes to triggering of a SEP. Meaning of digital, again, like data, digital also has a very wide meaning and implication as well. Whether remote transactions over a call, like in the case of call center services, would also be covered, to mean that systematic and continuous soliciting of business activities are undertaken in India through digital means. So whether, as it is mentioned, in a call center everything happens over a call, so whether that also would be regarded as carrying out business activity in India through digital means. Clarity is again required on that. Whether it is at the choice of the SSE to qualify certain transaction as SEP or subject to EL, as we'll see later, friends. What are the services which get covered under equalization levy? And if you see, there has been overlapping. So what gets covered in SAP also gets covered in EL. So whether it is the choice of the SSC or either of them would be applicable, whether a non-obstante clause is required, or which will prevail over what, clarity is required in that regard. Equalization levy for e-commerce operators, friends. Equalization levy generally for online advertisement. It was introduced in Finance Act by virtue of Finance Act 2016 at the rate of 6%, but now by Finance Act 2020, it has been extended. The scope of equalization levy has been extended for e-commerce operators also, along with the online advertisement, which will be effective from 1st April 2020. The e-commerce operator is liable to pay equalization levy at 2% on the consideration received or receivable from e-commerce supply of services made or facilitated by it to a person resident in India, to a non-resident under specified circumstances, to a person who buys such goods or services using the IP address in India. So if these three conditions are satisfied, e-commerce operator are liable to pay equalization levy at the rate of 2%. Who are an e-commerce operator? A non-citizen who owns, operates, or manages digital or electronic facility or platform for online sale of goods or online provision of services, or both would get covered. So your Amazon would get covered here. What is an e-commerce supply of service or supply or service? Means online sale of goods owned by the e-commerce operator, online provision of services provided by the e-commerce operator, online sale of goods or provision of service or both facilitated by e-commerce operator, or any combination of activity listed in clause 1, 2, or 3. So even though e-commerce operator would not itself do online sale of goods and services, but only a facilitation happening through that would also get regarded as, or would also get covered within the ambit of 2% of equalization levy. What is exempted from equalization levy? If the e-commerce operator has a P in India and such e-commerce supply, service, or facilitation is provided by such P, because again, if there is a P, the right to tax such a transaction would fall within the ambit of business income, and accordingly, taxation or attribution of profit would arise. Whether the income is a taxable under section, where the income is taxable under section 165. So if at all it is squarely getting covered in within the ambit of online advertisement, and equalization levy is charged at the rate of 6%, same shall not get covered again here. Sales of gross turnover or receipts from such e-commerce supply, service, or facilitation is provided is lesser than 2 crore rupees during the period. So there's a threshold being provided of 2 crores. If it is not exceeding 2 crores, this would not again applicable. What is the prescribed time limit for making the payment? Shall be paid to the credit of the central government for the quarter of financial year. So for your quarter ending 30th June, 7th of July. September 7th of October, December 7th of January, and 31st March again by 31st March. Consequences of non-remittance of equalization levy: interest at the rate of 1% for every month or part of the month. Penalty equal to the amount of equalization levy failed to be paid. So if there are continuing defaults and the interest as well as the equalization levy is not being paid, then maybe penalty as well. Again, as we see, friends, for every financial year, the e-commerce operator is required to furnish a prescribed statement. So every e-commerce operator needs to submit this statement by 30th June about all the transactions which have got covered within this ambit of 2% equalization levy. Caveats again, section 1050, which deals in providing exemption of income subject to equalization levy. So once there is a equalization levy on certain income, there is an exemption provided under section 1050. But however, there is an ambiguity here wherein like the equalization is levy is applicable from 1st April 2020, but exemption is available from 1st April 2021. So there would be issues in terms of double taxation for the year 2021. Again, whether once equalization is remitted on a transaction, revenue authorities cannot contain the non-resident company to have a P in India. So whether it would be a settled position when equalization levy is being paid, so no need of further checking P is there or not. Still, there is an ambiguity which needs to be clarified by the CBDT. Turnover limit of 2 crores, is it an entity level or party wise? Again, that clarity is required. Equalization is not a levy under the Income Tax 1961. Would treaty benefits still be available on such levy? Uh, as it is not falling part of Income Tax Act 1961, our view is it has been inserted by a finance act like how your service tax was introduced in 1994. It would not fall within the ambit of any of the provisions under Income Tax Act, and thus credit cannot be taken off for equalization levy when it comes to taking benefit of DDAA. TDS provisions, section 194O, again, which has been introduced by virtue of Finance Act 2020. Introduced by Finance Act 20 to bring the e-commerce into tax loop. 1% TDS by e-commerce operator. Say example, your Amazon and gross amount of sale or service or both provided by the e-commerce participant. So say there is XYZ vendor who is registered with Amazon, and say for example an individual purchases something from Amazon through that vendor, 1% TDS would be applicable. So 1% TDS has to be deducted by the Amazon from that XYZ vendor at the time of making the payment to them when there is settlement of payment. Again, there is no requirement that payment has to be received by the e-commerce participant. On payments made directly to the e-commerce partner by the purchase of goods, such payment shall be deemed to be made by the e-commerce operator. So, for example, if the payment for some reason is being made directly by the individual to XYZ and not to the portal, that is the Amazon portal, still in such a case it would be deemed to be made by the e-commerce operator to the e-commerce participant. TDS shall be applicable. The provisions is not applicable on payments made to e-commerce participants being individual or HUF. A gross amount of such sale or service does not exceed 5 lakhs, and PAN or Aadhaar card of such participant is furnished. So 5 lakh threshold has been provided if PAN or Aadhaar card is provided along with the other details. And again, it is applicable only for e-commerce participants being individual or HUF. For LLP firm or company, there is no specific exemption provided. In case no PAN or Aadhaar is available, it would be 5%. The tax rate would be 5%. No other provisions on TDS. So if TDS is applicable under this section 194O, no TDS under any other provisions would be applicable. Provisions of this section shall not apply to amount received by e-commerce but towards hosting, advertisement, or providing services other than those covered under this section. So advertisement is not falling within the ambit of 194A for very basic reason that already it is getting covered under section under the ambit of equalization levy. There cannot be a double charge of tax on the same type of transaction. Electronic commerce means the supply of goods or services or both, including digital products over digital or electronic network. E-commerce operator, a person who owns, operates, or manages digital or electronic facility or platform. E-commerce participant means a person resident in India selling goods or providing services or both, including digital products through digital or electronic facility or platform for electronic commerce. So, friends, here a person, the e-commerce participant has to be a person resident. In case a non-resident is registered under on Amazon, and a person in India purchases something from Amazon, yes, it will not get covered within the ambit of 194.0. There may be implications under section 195. Services includes fees for technical services and fees for professional services as defined in the explanation to section 9. So whatever has been defined under section 194J would get covered within the ambit of 194.0. Um, Apart from this, no other services would get applicable. Online sale of or goods would fall within the ambit of 194.0. Case study 1, Mr. X buys an air conditioner from Amazon for a sum of 40,000, makes an online payment to Amazon.in. Amazon, on making the payment of credit to the account of Messrs. ABC Limited, shall deduct tax at the rate of 1% of the transaction value. Now let's imagine in the above sum the payment is made by Mr. X directly to the ABC Limited. What would be the TDS implication? Amazon would still be under the obligation to withhold, even though the payment is directly made by the Mr. X to ABC Limited. TDS shall be applicable. Mr. Y, the service provider, avails advertisement from nobroker.com. Will such service attract the provisions of 194.0? No, because online advertisement have been squarely excluded from the ambit of 194.0. OECD's measures for taxing digital transactions or e-commerce operators. Again, there was in 2020, February 20, if I'm not wrong, there was a consultation document provided by OECD on taxing transactions in sharing and gig economy. What exactly is the meaning of gig economy? Is based on flexible temporary or freelance jobs often involve connecting clients or customers through an online platform. Refers to digital platform that allows independent freelancers to connect with individuals or business for short-term services or asset sharing. Example, your Airbnb, Uber, UrbanClap, Care.com would get covered within the ambit of gig economy. The market of online platform facilitating variety in the sharing is growing rapidly. So, to ensure greater transparency and minimize compliance burdens, OECD came out with a public consultation document and as to okay what would fall within the ambit of gig economy and what can be the taxability. So. The public consultation document was issued in February 2020, and recently, somewhere around 15th of April, the last suggestions were to be given. So suggestions have been provided to OECD even by our firm. So let's see what is the way forward in terms of taxability when it comes to gig economy. Again, there was a taxation of digital economy, a two-pillar approach, as we have mentioned earlier also in the introduction. That that again OECD came out with a two-pillar approach whereby digital economy or transactions in digital economy would get taxed. There were two rules or two pillars rather. Pillar one talking about the profit allocation and nexus rules, and second talking about the minimal level of taxation. uh, Again, outlines of the architecture of unified approach. So again, this was open for public consultation, wherein again the publication various views have been provided to OECD. By end of 2020, we are expecting that a confirmed methodology or regulation in implementation for digital economy coverage. Unified approach outline is designed to adopt taxing rights by taking into account new business models and thereby expanding the taxing rights of market jurisdictions. This is intended to restabilize the international tax system, assisted by enhanced dispute prevention and resolution procedures. To achieve these results, the approach encompasses three types of taxable profits. So again, there would be three amount ABC which would be taxed under this new regime. Amount A, a share of the deemed residual profit is allocated based on the formulaic approach to market jurisdictions using the new Nexus standard that is not dependent on physical presence. Amount B, a fixed remuneration based on defined baseline distribution and marketing functions that take place in the marketing jurisdiction. Amount C, the return under Amount C covers any additional wherein country functions exceed the baseline activity compensated under Amount B. So we have taken a webinar also on this on taxation of digital economy, OECD's recommendation, where they have focused on Amount A and B. For Amount C, there have again not been any approach which has been shared by OECD. So we are expecting a detailed regulation for that as well. So these were some of the thoughts, friend, on e-commerce operators and how there would be an importance for taxation when it comes to e-commerce, because as I said, many of e-commerce operators, even though when they operate from India, they get the major share of revenue from India, considering the population. Still, they end up paying no tax or very less tax. So, India has come up with various procedures on taxing points for these entities, and which we feel is correct when it comes to fair share of taxation. Any questions, any thoughts would be happy to address. Thank you, friends. Catch up next week on some other important topic.